Hey everybody, welcome back. It's your favorite no-nonsense financial coach. Hopefully it's your only no-nonsense financial coach. Otherwise we're going to be sending out cease and desist letters. Or maybe I'm due for a cease and desist letter in the mail because I've totally copied somebody's YouTube channel idea. Hope not. Anyways, oh gosh, that's bright. Like, comment, subscribe, share, all that stuff. I'm gonna say that early in the video because I think some of you tune out after about 37 seconds, which is right here. And yeah, just it helps the YouTube analytics. Like, comment, subscribe, share, all that stuff. Gonna start a series on investing, and this is, I don't even know, guys, this could be a 100-part series. First thing I want to talk about is just the basics of how the stock market works. The way the stock market works, because a lot of people don't get it. They think it's like voodoo magic, it's gambling. It kind of is in a sense, but having some knowledge, being able to count cards can help you a lot. Over the last 100 years, the stock market has returned an average rate of 8 to 10%, depending on how you look at it. And what that means is for every $100 that you had invested in the stock market, year over year, you would have averaged an 8% return, which means if you had $100 in there after year one, you'd have $108. If you had $1,000 in there, you'd have $1,080. If you had $10,000 in there, you'd have $10,800. If you had $100,000 in there, you'd have $108,000 after year one. And now this is average, okay? The market trends up and down. This last year, the S&P 500, which is an index that tracks market growth, it grew by 26.5%. Okay, so it wouldn't be an 8%, it was 26.5%. The way the stock market works is companies, when they get to a certain point, they'll start issuing stocks. They'll become what's called a publicly traded company. And each stock, each share, represents a percentage of ownership in the company. So if a company decides to issue 10 stocks, and you bought one of those stocks, you would have a 10% share or ownership in the company. Now, usually companies at the bare minimum will issue 1 million stocks when they go public at their IPO, which is their initial public offering. And then each stock is given a dollar value. Usually it starts kind of small at the initial public offering. It'll be $5, $10, $25, something like that. And as the company grows or shrinks, companies don't always succeed. Sometimes they go the opposite direction. The stock price or value will change. And there's a lot of things that affect the stock price and value. A good representation of a stock value is the company's total assets, basically what they're worth in cash terms. So the value of the products they create, the machinery and the real estate that they use to create them, their buildings, all that kind of stuff. But there's other things that factor in, like if there's a company, let's say, that only issued 10 stocks and there's 20 people out there that want to buy a stock from this company, there's a market demand higher than what the availability is. And so some stocks, because they're in high demand and in low volume or availability, they'll actually be worth more than what just the kind of the net assets of the company are. And you see that in most cases. So the way that this works for us as investors is at any given point, you can say, I want to buy into this company. And so you find a company that has stocks or shares for sale, and you buy them. And if they're, you have $100 and the stock's $25, you buy 4 shares valued at $100. Now, the cool thing about this is that as the companies grow, hopefully you're investing in companies you believe in and that are doing well and that are making things that are of value to society. As the company grows, the stock value increases. Okay? Now, there's a little bit of a difference between an individual stock and what I was talking about as, the total market, the total stock market and its returns over the last couple of years. If you look at Tesla's stock prices have risen phenomenally in the last 10 years. And it's because there's a lot of people that are putting money into the company that like what they're doing, and the growth rate has been way beyond what the market average is. You can look at a company like AT&T, and AT&T is going the opposite direction. And I'm not saying Tesla's a good investment and AT&T is a bad investment. It's just what the companies have done over the last couple years. So the way that this works is, long term, you just put money in the stock market. And there's really risky ways to do that, and there's really conservative ways to do that, and then there's ways that are kind of in the middle. The biggest trick to winning in the stock market is not timing the market. It's not buying low and selling high. It's to repeatedly, consecutively, over and over, month after month, to dollar cost average how much money you want to put in, and just keep putting money in. The people who get hurt on a roller coaster are the ones that jump off, right? So the way to win at investing in the stock market is you just keep doing it over and over and over, regardless of what any one day brings or 1 month brings. The people that got hurt the most in the tech bubble in the early 2000s are the ones that sold everything off right at the bottom. The people who got hurt the most in the financial and housing crisis in 2008 and 2009 are the ones that panicked on the way down and sold everything. 2020, March of 2020, the stock market tanked like 25-30%, and people panicked and they jumped out. So what happened was all their equity that they built up in stocks was lost in the fact that they sold when the values were down. Okay, so we're going to talk a little bit more about it. I hope that was helpful. Just a quick video. These ones I'm going to try to keep right around 5 minutes. I'm already a minute and a half past that. But that's how the stock market works. It's companies cut themselves into pies, and you can buy a slice of the pie, and if the pie gets popular and everybody likes the pie's value goes up in price, and your percentage of ownership in the company goes up in price. If it goes down, your percentage goes down. So yeah, that's pretty much it, guys. I hope this was helpful. I'll see you in the next one.